Microsoft shares have risen approximately 8.6% since the beginning of 2025. At first glance, that may seem like a solid performance, but it pales in comparison to the staggering 104% appreciation the stock has accumulated since the end of 2022, and this trajectory is far from random. Microsoft is one of the most solid and influential corporations in the United States, with annual revenue that consistently exceeds $200 billion. A significant portion of this revenue still comes from its long-established products, like Windows and Office, which were created more than 4 decades ago and remain highly profitable. In addition, the company generates considerable earnings from platforms like Xbox and LinkedIn. However, none of these traditional revenue sources have expanded as aggressively in recent years as Azure, Microsoft's cloud computing division. Created relatively recently, Azure already accounts for 38% of the company's total revenue. And it has become the central force behind Microsoft's accelerating profits. That's why many analysts believe that, with the advancement of artificial intelligence and the growing global demand for cloud computing, Microsoft may be on the verge of reaching a new level once again. And this time, the impact could be even greater. To understand why Microsoft stock could keep going up, you've got to start with the bigger picture. Since August 2024, interest rates in the US have been coming down, and whenever the Fed cuts rates, the goal is to boost the economy, which historically tends to push the stock market higher. Tech companies like Microsoft usually benefit the most. Back in early 2022, the Fed kicked off one of the most aggressive rate hike cycles in recent history, taking the base rate from 0.25% to 5.5% in less than a year. It was meant to fight inflation, but it hit market confidence hard. Microsoft's stock took a big hit during that time, dropping from around $340 in November 2021 to about $220 by October 2022. That's more than a 35% drop. Higher rates, more expensive credit, and lower growth expectations weighed heavily on tech and growth stocks like MSFT. Then in 2023, things started to turn around. The Fed paused rate hikes and held steady at 5.5%, hinting at future cuts. The market, always looking ahead, liked what it saw. Investors started pricing in a more favorable environment, stable or falling rates, and Microsoft stock bounced back big time, going from $220 to over $400 in just about a year. Now, with rates continuing to drop, the stock is still climbing, a clear sign of how closely. Today, as interest rates decline, stocks continue to rise, a practical confirmation of that relationship. With the prospect of further rate cuts ahead, the outlook remains positive for tech assets. But beyond the macro perspective, it's important to pay attention to what Microsoft's chart is telling us. One of the company's main revenue drivers, Azure, grew 31% year over year in constant currency. It is the only Microsoft division that has consistently delivered growth above 20% in recent years. This growth is directly tied to the rise of artificial intelligence, a global trend gaining momentum. Azure has become the engine powering thousands of AI applications around the world, from virtual assistants and recommendation systems to automation platforms, robotics, and large-scale predictive analytics. Companies like Meta, Mercedes-Benz, Siemens, and even governments rely on Azure's data centers to run their own AI models. At the center of it all is Microsoft, a company once known for office software, now the invisible gear driving the new artificial intelligence revolution. In Virginia, more than $2 billion has been invested in Boydton, home to one of the largest Azure clusters in the world. In Iowa, investments exceed $3.3 billion, capitalizing on the state's wind power resources. In Texas, San Antonio has become a strategic hub, with data centers connecting Latin America and the southern United States. Meanwhile, Arizona hosts facilities focused on AI and cold storage, leveraging the dry climate for better thermal efficiency.